The second chapter of the SCMPE soon. So first concept we have is cost of quality. Here the cost of quality is divided into good quality, that is cost of control, and poor quality, which is cost of failure of control. This is also called as cost of conformance, and this is called as cost of non-conformance. And cost of conformance is again divided into prevention cost and appraisal cost. Prevention, we will have engineering and quality audits. This is just an example. We have a lot more. You can refer to the main classes. Next, we have appraisal cost. Here we will do inspections and certifications. Next is cost of failure. Here we have internal failure and external failure. Internal failure is finding out the defects before the product reaches the customer, and external failure is customer finding out the defects. Here we have scraps, reworks, and in external failure we have returns and customer dissatisfaction. Next thing is we have PAF model. This is basically this: prevention, appraisal, and failure. Here we have 5 steps. So first we have to gather information about the number of failures. Then we will have assumptions to quantify the data. Then we will chart them as per the given chart. This one, COQ. And then we will allocate resources to the weak spots. Finally, we will do the study regularly and evaluate the performance. Next concept we have total quality management. Here we have 6 C's. First is continuous improvement. The process should be improved continuously, and there should be cooperation, which is involvement of every employees. Next we should have control. There should be proper controls, documentation, and overlooking, and commitment from the top. And there should be customer oriented, both internal customers and external customers. And finally the culture should be changed, the attitude of the people should be changed. Next small concept we have is PDCA cycle. First is plan, second is do, third is check, and fourth is act accordingly, and again plan. This does not end with the act. Next concept we have is supply chain management. So usually the traditional model is push model, where the suppliers will be providing raw materials to the manufacturers, and they will produce the final goods and give it to the distributors. Then it will reach retailers, and then finally it reaches customer. But in the modern day environment, this is modern, we have pull model, where customers will demand the product and then only suppliers will produce the product. So this works on anticipated demand and this works on actual demand. Here we also have 2 types of flow. U is basically the company. We have supplier and customer. All the transactions done with the supplier is upstream flow, and all the transactions done with the customer is downstream flow. Now, how can we bring in information technology in upstream flow? We can use e-procurement, e-sourcing, e-purchasing, and e-payment. And in the downstream flow, we have e-business and email. In the downstream flow, we also have 6 markets. First one is internal markets, and which is staff basically. And second is referral markets, where we have existing customers to refer us to new customer, potential customers. Then we have influence markets, where we have analysts or shareholders. Then we have recruitment markets, where universities, we are linked to the universities so that we can connect to the potential employees. Then we have supplier and customer markets, which we can form a strategic alliance with the suppliers. And customer includes existing as well as the prospective. Next concept is customer account profitability. That's basically 5 steps. We will have the customers first, and then we will divide them into segments. So analyze the customer base, split into segments. Second step is calculate the annual revenue for each of the segments. Third is to calculate the actual annual cost of each of the segments again. Then if we will check if it is profitable or if it is not profitable. So we have to retain the profitable segments, and we have to eliminate the loss segments, that is unprofitable segments. Then we have a small concept, which is customer lifetime value, which is the present value of net profit of the customer over the entire lifetime. So here you will get the practical sums. You just have to do these steps. First, calculate the revenue from these customers, and it should be brought to the present value. And then we calculate the cost. It should also be the present value. Finally, we calculate NPV, that is net revenue, which is just a subtraction of both of these. We will get the customer lifetime value. Then we have a small concept, e-gain sharing agreements. So we should be able to review and adjust the existing contract. It should be flexible, it should be revisable in such a way it benefits both the parties. Then we have these three concepts, which is first one is downsizing. It is a HR activity where we reduce the work, where we redesign the work, or it is done because of systematic strategy. It should be used only in cases of emergency and only for the survival. Next, we have outsourcing, where we will transfer the non-core activities of the business to external specialists, and it will provide us with the improved productivity, reduce cost of operation, and flexibility scale up or down. Then we have offshoring, where we relocate the business to another country, where the physical infrastructure will be in a different region, and there will be reduced cost, and we have collaboration synergies, and government policies will also be helpful for us. That is pretty much the second chapter.